Maverick traders, welcome out to your currency midweek update for September 21st. Corey here with you, and of course today is FOMC meeting day, so we're going to be trading the Fed meeting together here shortly. As always, let's make sure that we manage risk, that we trade appropriately in terms of risk, reward, probability, etc. Before we get into it, let's do a little bit of a review of what's going on in the market. So equities, we're still in this bear market. We've kind of emphasized that point that you're still operating in a bearish market environment. You can see all of the typical characteristics. Risk assets are going this way. Defensive assets like the US dollar, US government debt, treasuries, and so on, where people go to hide out, they're going that way, right? And so you have this very much a bear market environment. Now, that doesn't mean that everything is going down every single day, but that's the direction the trend is going. The expectations for a recession are pretty high. Actually, in this midweek last week, we pulled up the yield curve and we compared the 2 to 10 and looked at the history of that kind of happening when it goes inverted. That happens typically before a recession, usually about a year or so in advance of that. And I think, next year, towards the end of this year, we'll kind of be moving into that recession fully, where it's just kind of obvious and the economic data shows that. The US dollar spiking higher, and that continues, and we've talked about as long as that's happening, it's going to be really hard for commodities, for stocks, for, Bitcoin, for gold, for silver, for all these things to go up. It's just not in the cards. When the US dollar is surging higher, most of these other areas of the market suffer. Crypto being the most volatile, down the most, and it's kind of a little bit of a beta thing. The more kind of volatile you are, the more deeply you've dropped. And that makes sense in a lot of different ways. So far this week, we have had Canadian CPI, which came in at a lower number. So we're seeing a drop in inflation in Canada, which is a good sign. Remember, inflation is global. It's an issue around the board. And then existing home sales, a little bit better than expected. A few more houses being sold than the expectation. That's a solid data point because housing has certainly been suffering of late, and all of the numbers have kind of been tanking a bit. The Fed's expected to raise by 75 basis points, by 0.75%. The expectation is that it's either that or a full 1%. I wouldn't be shocked if they raise by 1. I'd almost see it as, I think the market would knee-jerk reaction would be negative, but I actually would look at that as a positive in that I think the quicker we get the Fed to catch up and the quicker we get them to move rates up to where they're going, the sooner the pain ends. And it's kind of just, rip off the Band-Aid all at once type of thing rather than just pulling it off slowly and having this pain linger on. As we look at the weekly performance, most everything a little bit lower. Crypto being up about 1% means flat, when it comes to crypto, of course. Now, as we look at the weekly performance here, you can see in terms of price action in crypto and so forth, it's basically a little bit of a mixed picture. We'll come into that in a second, kind of look at that more closely. The S&P chart, and I think we grabbed, this is the wrong chart because that doesn't look quite right, but let me pull up. It looks like that time frame is off. So here's your daily chart of the S&P, and this one looks better, right? We're in a little bit more of a downward trend of late. We talked about this trend line, and this trend line that had been in effect for the past few months was broken last week. And when that broke, it really created more downside, more deterioration and such. And I suspect that that's still going to be the path. Now, it wouldn't shock me if we rally back up. In fact, you oftentimes will kind of rally underneath a broken trend line and kind of test it from underneath. That's the idea behind a head and shoulders top. A lot of times is that it's an uptrend that becomes broken and then kind of tests the underside. So you have a trend line in place and it tests the underside, and so you have these shoulders, head, shoulder, that type of dynamic. Well, we've broken this trend line. Now we might rally up underneath it, but ultimately we're likely to fail. So I think we could. It wouldn't surprise me at all. I kind of think it's probable that we'll get a push up and retest that. But ultimately, the path of least resistance is to the downside, and I still think that's where we're headed overall. So as you kind of look at the price action in currencies, there's, Kiwi having a bad week, and then the defensive currencies, US dollar and Swiss franc specifically, having a good week so far. That's pretty much it. Everything else around the flat line. Last week, we kind of harped on just one trade idea, pound Aussie, that met the Bollinger Band criterion. We'll do a review of that one. I know a few people traded that. As we look at crypto, again, this is pretty darn flat. I mean, crypto moving 1 to 2%, that can happen in moments. That's a couple of minutes. So not too much there. Let's take a look. Our market outlook is still bearish, big picture. I think we're in a bear market. That's probably where we're going overall. International stocks, once the US dollar stops going up, these probably bounce back sharply. But that's not what's happening right now. I would still anticipate further declines in that area. So, whoops. How did we get backwards? I clicked on the wrong chart here. I wanted that one. So there is the international chart, and you can see again the downward sloping, downward trending price action. I still would anticipate lower prices upcoming. As we look at crypto, this is a little bit of if you were to go out big picture, and we might want to look at that, this just hasn't done anything for a very, very long time. And maybe we'll look at it on a little bit longer time frame out here. So let me go back to our live charts, and if we just look at crypto overall, this is your daily chart, and you can see it's just, it's been in this big range. Even if we went into the weekly, look at how many weeks in a row you've just been stuck here. That's 8, 9, 10. I don't know how many weeks in a row that is, just basically sideways, but it's a lot of them. If you look at the daily chart, though, a little bit of a breakdown starting to happen in crypto. So you can see that we just recently broke below the bottom end of the range, and we're kind of bouncing the last 2 days underneath that. I would still, again, probably anticipate that further declines are upcoming. That would still be, to me, again, the path of least resistance seems to be on the downside. So even though we're getting a little bit of a short-term bounce, still probably where we're headed. Now, this is the event today. We're at 2.5. The Fed's either going to 3.25 or 3.5, in that category, in that area of interest rates. And we'll find out soon enough. I still would think that it's going to be 75 basis points. So we'll go to 3.25. I think that's most likely. We have some other events, though, this week. We've got the Swiss National Bank. We've got in the UK, Bank of England is going to have their meeting. Both of those happen overnight. And then on Friday, you get some European PMI data, along with Fed Chair Powell speaking on Friday. So sometimes they'll schedule, a Fed chairman to speak later in the week just in case things go haywire. Maybe he can speak a little calm into the market or whatnot. Maybe clean up a little bit if there is some mess, but he will speak to kind of wrap up the week. So we're jam-packed with events. We're jam-packed with opportunity. We'll try to look at various currencies and find the best opportunities accordingly. So last week we talked about pound Aussie, and it had this short setup, right? It hit the upper band, was below this 50-period moving average, and that's on the daily chart. Now, the short-term charts hadn't rolled over quite yet, the 1 hour and the 4 hour. Well, that happened the very next day and into Friday. And we're down, a couple hundred pips from there. Probably still more to go, quite honestly, but down a couple hundred pips from that level, 171, or pardon me, 1.7125 down here to below 170. We've gone down a pretty good amount. Next stop, probably still down towards the bottom of the Bollinger Band, down here towards that swing low. Seems like where we're likely to go. So that trade is working or has worked, depending on how quickly you traded it. Should have been a good one. Now, let's take a look at a few other charts. And if you have any requests, fire away. I'm going to go into a couple of different time periods. Let's go US dollar, first of all, because that's what we're going to be trading this week. Or right now, is more specifically. And you can see the US dollar is really broken out to the upside. Continues to do that on a longer term time frame. I mean, this thing has a multi-year breakout. So it's been happening for some time. It had a little choppiness when it went to parity with the euro, kind of initially spiked through there and then had this give back, right? Here's where it spiked through against the euro, and then it gave a lot back, and now it's kind of climbed its way back up, still just working higher. And so, you can overthink things sometimes. This is a very strong chart. The risks here, if you look down here at this indicator, the RSI, this stands for Relative Strength Index. And when you get above 70, you're quote unquote overbought, kind of overdone on the upside. If you were ever to get below 30, which it hasn't done, but down here maybe it came as close as it was. If it ever got below 30, that would be considered oversold or too low on the downside. One of the things that you can do is look for divergences. So if price goes to a new high, but the indicator does not, that's a little bit of a warning sign. And here you can see a bit of a warning sign there in terms of the price action. That basically a higher high in price, and it was making lower highs. See how this peak hadn't gone as high. It's a slowdown in momentum. It's basically a slowdown in price action. And so as you look at this, an expectation that a correction looms, that basically it's running out of gas. Right now, we're making higher highs in price, and we're still not at higher highs on the indicator. Okay, we can say higher high here, still at a lower high here. Now, the problem with this indicator is it's certainly not a good precision. Like, just because you're in a divergence doesn't tell you when it's going to turn. It doesn't say that, well, we're kind of running out of gas, but if you've ever been in a car that's running out of gas, sometimes you can be surprised at how long it lasts and just keeps going, right? You're like, man, I feel like we're on fumes, but we keep going. That's what price action can do. Could it go up for another day or two within this divergence? Sure, it's not going to be real precise, but it is giving a little bit of a warning. The gas light is on, suggesting we're running out of gas. So it's our job to kind of say, okay, where did it finally run out? Once it finally runs out, then we can kind of bet against it, but not until that time. And right now, the gas light's on. We've got a warning, but that doesn't mean that we have a trade yet. And so, sometimes you have to be a little bit patient here. I mean, the price action's up, but we do have a little bit of a warning that the US dollar is maybe not as strong as it was previously, that the momentum is waning. And that's what it basically suggests. If we come into a little bit shorter time periods, you can see the same dynamic and even maybe a little bit more pronounced. So see how price and indicator have clearly diverged. Two roads diverge. I took the one less traveled, whatever that means in terms of trading. It basically, while everyone else thinks that this is just the path to prosperity, I've got a little bit of a warning that I'm going to take this path when the opportunity arises, right? That's the suggestion that these US dollar charts are giving, is that, hey, we're still going up, true, but we're not going up in the same manner. We're kind of running out of gas a bit. So generally speaking, there's been something that I used to trade around the Fed, is that usually it's the day after. Like the day of the Fed is just chaos, right? I have no idea how the market's going to take it. I don't know if they're going to raise by 75 or 100 basis points. And I don't know that it really matters. There's going to be all this chaos, and there's high frequency trading that takes place. There's going to be computerized systems. There's going to be all this nonsense to a certain extent, right? Knee-jerk reactions and fading of moves and so forth. But if you really want a market turnaround, usually the day after is, we used to call it, back in the early 2000s, they had this saying that was called Turnaround Tuesday. Well, in this case, it would be Turnaround Thursday, because Thursday, the Fed announcements are on Wednesdays, and Wednesdays just become a complete, chaotic session. Thursdays are often where you get the exhaustion, where you get the major reversal. So maybe we put a finishing touch on this. Maybe we kind of put an exclamation point at the end of this sentence. Could I see the dollar kind of blowing off to the upside, and then tomorrow is where we start to actually decline? A turnaround Thursday to me seems more likely. So I'm not against still buying the US dollar. Yeah, we've got some warning signs. Do I prefer being short? Again, it depends on your time horizon. We'll probably be trading a 1 hour chart or something a little shorter term. So I'm not against trading this in either direction, basically, even though we have some warning signs. Turnaround Thursday is more likely than for a turnaround Wednesday, for this to be the high. Would be less likely than actually that it would put in the high early tomorrow. So let's look at a few of these crosses. Here's US dollar yen, 1 hour time frame. You can see the dollar's coming off just leading up to this event. Dollar CAD, again, it's kind of selling off in anticipation. Dollar Swiss franc, you can see the sell-off that's starting to happen in anticipation. Euro bouncing back. Again, this is the US dollar going down, euro bouncing back, Aussie bouncing back, pound bouncing back. So right now, as we come into this meeting, the US dollar is selling off into the meeting. I wouldn't put much weight behind that. That might reverse very quickly. As we look at a few of these, if you are thinking bearishly, if you wanted to play something to the downside against the US dollar, the Kiwi could be an obvious choice. It's one of the weakest currencies, one of the weakest charts. If we were to look at that, if you were to go back on the daily time frame, I mean, you're in a downtrend, right? You're in a downtrend. You've been trending lower for some time. You had maybe an inverse cup and handle there, further declines, etc. Kiwi would be an obvious potential candidate. If you were trying to buy something against the US dollar, that becomes a little more tricky, because there just aren't a lot of things that have been doing very well against the US dollar. I mean, nothing really has done well versus the US dollar as you look at these charts. It's just been US dollar strength across the board. So you'd have to somewhat play counter trend if you were going to try to short the US dollar on like an hourly chart or anything like that, you'd probably have to play reverse, you know, trend reversal or some sort of aspect like that. And I just don't know that that makes sense. I mean, everything, if you're trading here and you're trying to buy euro or whatever it is versus the US dollar, you just have a lot of headwinds. You got a lot of overhead resistance and such. Can it go higher? It can, but you know, it's pretty difficult. So that's why I say shorting the US dollar is probably a day early. Turnaround Thursday seems more likely to me that we would have short setups against the US dollar more tomorrow than today. That makes sense to me. So just from a charting perspective, I almost have to just kind of look at playing, you know, things against the US dollar in the trend that they're going. Maybe we get an opportunity to short the Kiwi against it, or maybe we decide that we want to short the Aussie against the US dollar or something like that. I mean, these trends have been working lower, even with a little bit of a reversal happening here on this 1 hour chart. Exactly right. I mean, if you're trying to short the US dollar, you got to be buying stuff like this that's in this downtrend and betting on it going higher. It could work, but it's just very difficult. You know, that form of counter trend trading is just really hard because it doesn't work most of the time. And then even when it does, it kind of struggles a lot of times. It falls back and retests the prior lows. So even if you kind of pick the bottom here, you might be really frustrated because it initially spikes, but then it comes right back down and you end up getting stopped out or whatever. And then it works its way higher. And sure enough, it was a reversal, but it's just difficult. It's not, you know, easy to pull off. What about US dollar, Japanese yen going into the event and tonight with the yen, the Bank of Japan? So if you're playing dollar yen, you've got the same issues again. That the dollar, you know, to go down, it just has levels of support, and trend lines, and all the momentum is this way. So that's hard. And then if you wanted to buy the US dollar against the yen, the problem is, again, we feel like the US dollar's running out of gas a little bit. And, you know, if you were to trade any Bank of Japan meetings, then you run extra risk that they kind of let off the gas and maybe adjust more towards the rest of the world and talk about raising rates or doing anything that way. And if they go that route, I mean, the yen could be up dramatically. So it's just hard. I mean, I don't know that maybe you see it differently. I like to come in and say, okay, here's what I'm watching and here's what makes sense. It's just hard today. I don't know that I can really pound the table on anything. My thought would be that we just have to buy the US dollar. We just have to keep buying it here against these charts and, you know, see what we can do. What you short against it, be it pound or euro or these different things, I mean, that's up for debate. I'm kind of leaning towards the Kiwi just as more of an obvious potential candidate and such. All right, we are coming in where we add on the clock. So we've got about 3 minutes. Let's think about possibilities here. So if you look at this daily chart, I mean, the trend is down. If we come into shorter time periods, you know, here's the 4-hour time period, here's the 1-hour time period. How do we trade it? I mean, you just probably have to go pretty darn short term. I just don't know that. I lack conviction. I admit that. So if I were trading it, you'd almost have to kind of look at this as maybe we get a spike that can trigger something. Let's go into these charts. I'm going to come into the 1 hour and I'm going to come in kind of like how we were trading pound Aussie. I'm going to think about Kiwi US dollar in kind of a similar vein. So if we were to take a closer look here, what I would kind of be thinking about is maybe you get a spike up that we can fade off. You know, maybe a spike up towards the upper Bollinger Band. You're still below this 50 period moving average. Now that's on an hourly chart. It's not a trade that we're going to be in for days or weeks. I mean, this will be a couple hour trade or whatnot. But kind of, you know, similar to this where you hit the upper band, you stayed below the 50 period MA, and we dove. That's a bearish Bollinger Band setup. You might get a little spike up here in Kiwi USD. And I think, you know, depending on the energy and the momentum and such, that might be something that we could kind of fade. A lot of these US dollar charts have similar patterns. They're down a lot, and it would take quite a bit of rally to get back towards that upper Bollinger Band, you know, back towards it. But Kiwi is the closest, and Kiwi has maybe the best setup for that type of thing. So I would probably place this as a second stage setup. We're not trading the announcement, the first spike. We're going to trade to do the second stage, probably fade that first reaction would be the way I would be thinking about this. So let's see what happens here as we come into the announcement. And immediately we're going to get the news as far as, you know, whether or not they're going to raise by 75 or 100. And you'll probably see that in the price action. If we come in at 75, it's more likely to be a muted response. If we come in at, you know, 100 basis points, it maybe could get a more severe reaction. My thought would be maybe the 75 is what could create the Kiwi spike. Just a knee-jerk reaction. Oh, they didn't hike by as much, and we spike up there, and then we could fade that. That might be wishful thinking, but that's the thought that I have. So one thing that I do in these events is I would get an order ready at kind of the price levels you want. You might even attach a stop loss to it. So you can see the reaction, the knee-jerk reaction was immediately down. So immediately it was buying the US dollar, right? The US dollar spiked up on the first part of the news. So instead of spiking that many pips this way, which we would now have a setup right here, right now, it's going that way. So US dollar's rallying. You know, why is the US dollar rallying? Well, they must have had something in the statement that was seen as hawkish, something that suggested that they're on the path towards more rate hikes, towards getting inflation under control and such. I'm not shocked by that at all. I mean, that's the message they've been portraying consistently. So you can see a big energy spike, and sure enough, US dollar is spiking higher on that. I was hopeful that we'd get a little inverse reaction and then trade that second stage. But so I think, I mean, this is what the charts have been showing, is that you just have to keep buying US dollar. It is a little bit tempting coming back to this thought process of, is the US dollar running out of steam? And if it is running out of gas, you know, this can be that exclamation point at the end of the sentence that we were talking about. Remember, the divergence, two roads diverge, you know, and a lot of times they'll finish with a big exclamation point. That might be what's kind of happening here in USD, is maybe this is a bit of that final spike. So plan B, since we didn't get the setup, would be to fade this reaction, to basically, you know, say, okay, I get that I'm playing counter trend, but see how we're kind of fading off of the highs. You stick your nose in there. This doesn't always work, by the way, but we have specific reasons why we think this could be an exhaustion, be an you know, divergence and such. And you basically stick your nose in there and say, well, what do I want to buy? And I'm going to short US dollar against it, you know. And so you're looking at some of these pairs and you say, okay, Euro USD is at 98.29. Maybe I go ahead and buy here and put a stop down here below 30, 40 pips and just basically say, I'm going to try to fade this reaction. You'll either get stopped out really quick or the fading will kind of work and it'll start to come back. I mean, all it would have to do is go back to where we were pre-announcement and you've got 50 pips for your, 30 pips of risk. So I think it makes sense right here at this 98.25 level. I'm going to trigger it and I'm just going to put my stop basically right there down there at 97.99. I'm just going to put in 30 pips lower and let's see what happens here. I don't dislike that at all. And the way that I would trade this is as follows. If you're inclined to think this plan B might work, but the first thing is as we come up here and we make about 30, 40-ish pips, I'd probably take off half. Take off half, I wouldn't adjust my stop loss up. A lot of times I do that, but for me, I'm going to leave my stop loss. Actually, it's lower than that. It's right down here. I'm going to leave my stop loss here on the other half. Why? Because if it comes all the way down to stop me out later today or something, well, then I broke even, right? Because I made 30 or 40 here and I lost 30 or 40 there. It's just not it doesn't matter. I want to stay out of the choppiness, and the expectation is that this might be, imagine turnaround Thursday happens and so forth. This could go a couple hundred pips, fairly easy, at least into the end of this week. It could be right back up here in the 99s. So to be up 100 pips or so by the end of the week, not out of the question at all. So that's how I would think about this. We are sticking our nose out there, and I don't play counter trend like this very often unless I really feel that we might have that stage 4 exhaustion. Stage 4 exhaustion in place, right? What's the stage 4? Well, stage 1 is consolidation. Stage 2 is a breakout or breakdown. So this would be stage 1. This would be in stage 2. You usually get the trend. That's all stage 3, that trend continuation. And then at the very end of this thing, it makes an exhaustion move, kind of that capitulation as they call it, throwing in the towel. Oh, I've had enough. And the Fed meeting could certainly be that for US dollars. And so that's what we're trading. I think it's not a high probability setup, but it's a good risk to reward and it's a decent probability given the mixture of what we see, given the mixture of the various things that we have in place. So yeah, when I say take profits on half, that simply means that say you bought a full lot. Say you bought 100,000 position size, you just sell 50,000. And now you'd own 50,000, right? You're just getting out of half of your quantity. It's like when you buy stock, if you buy 200 shares, if you take a half exit, you sell 100 shares, but you hold on to the other 100. It's just in your quantity. You're just taking off half of what you own and then leaving the other half on, right? So if we get a push up here towards about 98, 70-ish, that's where I'd probably be looking to take profits on half of it and leave the other half. So whatever you have position size wise, if you had 500K, well then you'd be exiting 250 of it and leaving the other 250K on or whatever, right? So that's kind of what we're playing there, is the potential for a stage 4 exhaustion. We'll see. If it's not working, it'll be stopped out pretty quick. All right, and then you just adjust your stop loss. Yeah, so if you were changing your stop loss price, you could change that, but you definitely change your stop loss quantity. So if it rallies up here and we sell half of our position, we need to come back here and change the quantity to reflect that we only own half, right? So if I sell 50K up here, I need to come adjust my quantity on my stop loss to 50K because that's all I own now is half of what I owned before. Good stuff. All right, let's jump back here. The rest of this week, let's see what we've got on tap. So we've got quite a bit. We've got a guide to high percentage trading and day trading versus swing trading. Couple of recordings, couple of videos coming out. As always, we'll have our recaps, and then we will have the end of week kind of trading room getting prepped for the next week. So thanks everyone for being here. Have a great rest of your week. Any questions, anything we can help, don't hesitate to ask, and we'll see you next time. Goodbye, everyone.